of 1%. Today was supposed to be a comeback day after a really ugly day yesterday. What does all this action tell you about what is getting priced in?
Well, I mean, as I said, 3 or 4 weeks ago, I thought that NASDAQ would be in a bear market and S&P in a correction, and I think we're there. I'm beginning to find it interesting from a longer-term perspective for long-term investors. I think the bigger problem, more than even energy prices, is that the Fed does not just use Ukraine as an excuse not to raise rates, because we have a very fundamental inflation problem that goes way beyond oil prices, and it would be a big mistake. The medicine will just have to be stronger down the road if they don't start raising rates and controlling the inflation. I think we're going to get a very bad print coming up on March 10th in a couple of days. I think almost 8% year over year, and believe it, I think we could get to 10% year over year on the headline. And to me, it seems silly to debate, should we go from 0 to 0.25%, 25 basis points, or 0 to 50 when we could have 10% inflation. I think we have to be more aggressive going forward. I know the market's delicate. I know that's a problem. But that's no reason not to take the medicine we have to take to slow the inflation.
Well, Professor Siegel, I mean, certainly not just the market being fragile, but the Fed doesn't have to decide on how many it's going at the next meeting. It just has to do the first one, and then we can wait and see, right? And it doesn't necessarily have to just worry about the markets, but also the idea that what is happening with oil prices at a certain level becomes a restraint on consumer spending and maybe even a brake on the economy in itself. So maybe it's going to do some of the Fed's work for it?
Well, I mean, that's true in terms of slowing the economy. But one good thing there's two good things to remember about this oil surge. And I know there's been a lot of talk that oil surges have preceded almost every recession in the post-war period. But one has to realize that the U.S. economy is only 25% as oil intensive as it was in the 1970s. In other words, we use 75% less energy to produce $1 of GDP than we did 40 years ago. So certainly it's going to hurt on your in your wallet and filling up your gas tank. But in terms of total output, it is not as important as it once was. Secondly, we are virtually energy independent. Really, we don't import anywhere near the amount of oil that we did in the 1970s. So that every dollar that goes out of consumers' pockets for higher energy is going in back mostly to American pockets of producers. Now, that doesn't reflect in the stock market because capitalization of energy stocks has fallen so low. But we are still not going to have the impact of these prices as we did 40 or 50 years ago that really caused one of the most severe recessions in the post-war period.
More companies announcing changes in Russian business. We've been on this all day long here on CNBC and all show long. Pepsi, who we've been waiting for, PepsiCo, just making an announcement through a memo from their CEO, Ramon Laguarta, who sends a note to associates saying they are going to, given the horrific events occurring in Ukraine, we're announcing the suspension of the sale of Pepsi Cola and our global beverage brands in Russia, which includes 7-Up and Mirinda. Also suspending capital investments and all advertising and promotional activities in Russia. Pepsi, though, does note, and the CEO does note, that daily essentials like milk and other dairy offerings, baby formula and baby food will continue to be sold to the Russian people. And just to underscore how difficult some of these decisions are for some of these multinational companies, in the memo it says they have 20,000 Russian associates and 40,000 Russian agriculture workers in the supply chain as they face significant challenges and uncertainty ahead. But clearly a statement when it comes to suspending sale of Pepsi Cola in Russia. It's a market that Pepsi entered, they say, at the height of the Cold War to create some common ground between the U.S. and the Soviet Union. And Coca-Cola came out just moments ago, suspended all business. That's about 1% of revenues. Pepsi has about 4% of the revenue. They have been considered one of the most exposed global consumer staples to the market. It sounds like they'll still get some business there, but suspending capital investments, advertising, promotions. It shows that they have this delicate dance.
Yeah.
It's sort of like P&G, which is still, from a humanitarian perspective, going to keep some of the staples on the shelves. Professor Siegel, do you think we're going to see this in earnings? I know that it's not hugely material for some of these companies, the Russia exposure, but between Russia, Ukraine, Europe, which is expected to slow down from all of this, earnings get readjusted, don't they?
Yeah, certainly. And I applaud all this pressure. The more pressure, the better. But again, remember, stocks are really long-term assets that capitalize years into the future. You know, this pressure against Russia, now we don't know how it's eventually going to work out, but some people, I mean, it's brought together the West, it brought together NATO, it may deter China going into Taiwan. You know, this pressure, if it succeeds in Putin not achieving his objectives, is a big gain for the world. And if he gets toppled one way or removed from office, these firms are going to move back in, and we'll have a better world because of that. And I think when you think about, should a stock price go down, let's say 10%, because it is not dealing in Russia, the math doesn't work out that way. Despite the fact it's a short-term hit, despite the anxiety that all of these events are causing, looking beyond that, there are positive factors.
You know, from a longer-term perspective, Professor Siegel, globalization and even the secular decline in commodities as a central, point of our economy has been, given credit for higher valuations in equities, right? I mean, it's part of the long-term story for why equities have actually done well and have generally gotten higher valuations. Is there a danger that we're reversing some of that longer term?
Well, we're still not to commodity prices that we were in the 70s or even the oil price. Well, I guess we just about hit it as we were before the financial crisis. By the way, I heard some people saying, back in 2008, and then we had a recession. That was really caused by the subprime mortgages and the collapse of the financial sector. Yeah. Oil had not too much to do with that recession.
But look at that. But sorry to cut you off, Professor Siegel, but we have to mention the yield curve. What about the signal we're getting there? It's like, 25 basis points on about it keeps flattening.
We're going to
invert.
We have to invert it. We're going to have to invert it, and we're going to have to. Long-term interest rates are going to be much lower in the future. We must raise the short-term rate above it. And by the way, I think that's going to be much more common in the future to have inverted curves, and they don't have as much of the scary prognostications that they did before. We're going to have to raise that short rate, in my opinion, eventually to 3, 4, 5% in order to tame 8 and 9% recession. The long rate could beat at 2.5 and 2 3/4. Don't be afraid to do that. It's going to be worse if we refrain from that. We're going to have more inversions in our future than we've had in our past.
All right, that would be a big adjustment. We'll see if the Fed is willing to go ahead and do that. Professor Siegel, thank you very much. We'll talk to you again soon.
Thank you, Mike, Sarah.